Accounting is an integral financial aspect of all businesses, used accurately to manage cash flow and assess a business's overall financial position. In particular, adjusting journal entries ensures all accounts are up to date at the end of the accounting period. This ensures compliance with the matching principle, which reports revenues in the same financial period as a related expense on the income statement. Transactions may not be recorded as they occur, such as salaries. Thus, adjusting entries must be made in the general journal after the trial balance has been prepared. All transactions impact revenues and expenses. This records incurred expenses and earned revenues that have not yet been recorded. There must be one account from the balance sheet and one account from the income statement. Adjusting entries never involve cash, as it is not a transaction. There are 4 classifications of adjusting journal entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. For example, deferred revenue refers to cash received upfront before revenue is earned. As the revenue is earned, an adjusting entry increases revenue and decreases unearned revenue. For example, customers pay $45 per month on the 1st of January for an upfront mobile data plan with a service carrier. This is initially recorded as debit cash, credit unearned revenue. At the end of January, 1 month of service has been provided. The entry is adjusted as the service is used: debit unearned service revenue and credit service revenue. Secondly, accrued revenue refers to cash received after revenue is earned. Initially, when cash is collected, accounts receivable is decreased and cash is increased. The adjusting entry increases both revenue and accounts receivable. For example, customers pay $45 on the 1st of February for January mobile data plan with a service carrier. The payment received is recorded as debit cash and credit accounts receivable. At the end of January, this revenue is adjusted by debit accounts receivable and credit service revenue. Deferred expense refers to cash paid before an expense is incurred. When the expense is incurred, an adjusting entry increases expenses and reduces prepaid expense. For example, a company pays $800 prepaid rent at the beginning of January. This is adjusted at the end of January. Debit rent expense $800 to increase and credit prepaid rent $800. Accrued expense refers to cash paid after an expense is incurred. An adjusting entry increases the expense account and a corresponding payable account. For example, a business accrues $6,500 salary expense in January and will pay employees for their service on February 1. To adjust this entry in the period that the expense was incurred, the business needs to debit salaries expense to increase and credit salaries payable. Therefore, adjusting entries are vital to include in a business's financial statement arising due to the timing between the exchange of cash and expense or revenue recognition. Depreciation must also be taken into consideration as assets are used up over time, therefore impact the accuracy of financial statements.